Hey traders, it's Greg here, and I'm sitting with Dan and going over some potential positions that we're looking at, and one of them was XLE, and we're having a conversation about buying that outright versus doing the options. So I'm going to go over the technicals here as I see them, and then I'm going to ask Dan to explain the thinking behind the option strategy. So with the XLE here, just give me a second here. Yeah, okay. Point out to the pattern here is not the greatest. However, I believe it's at a turning point, and I'm going to explain why. What I see good about it, what I see about it that I'm not so interested in. So I mean, overall here we've got this big top, where it had this great rally a few years ago, and then it retraced all the way back down. You can see the downtrend, lower highs and lower lows. It gets down here to this major support area. So what's the good here about that? Well, on the monthly chart, earlier it took out this area of significant resistance. So it broke the back of that downtrend there. We don't, and again, little input here on lessons here. We don't need downtrend lines and drawing lines. We just look at the prior swing high within a series of lower highs and lower lows. It takes out the swing high. It's broken the downtrend. Simple. So now that it's done that, it moved up in a really powerful way. It consolidated at resistance. Beautiful. It broke out. However, then it pulled all the way back down to the bottom of this breakout bar. So that is not attractive. However, it's beginning to stabilize here, and we've got the beginnings of a bottoming tail bar. I wish it had more volume. It doesn't. But as we move to the lower time frame, we can see that it is it's bottoming out here. So if you didn't catch it, this is the monthly chart of XLE. As I said, it's pulled back here multiple months in a row. It's beginning to stabilize. So now we want to look to the lower time frame and look at an X-ray, if you will, of the transition that's beginning to happen. So here is the downtrend that we saw, that pull back toward the bottom of the wide range bar on the monthly. And as it came down here, now we've got this big volume spike as it broke to the downside, and it immediately reversed back up again. Now, it hasn't taken out the prior swing high. So the trend is still down. However, and here's something to note of with trends, in this case a downtrend. Something to take note of is the retracement between the prior swing high and then the swing low. And we've got, I'm eyeballing it here, probably about, give or take, an 80% retracement. Which is good. I mean, it's the start of a potential turn, and what we have here, like a head and shoulders type of a bottom and a reversal here. So this pattern, in alignment with the support from the monthly time frame and this volume, the downside, break that didn't follow through, suggests the potential for this to be at the point of turning around and a move, toward this resistance and maybe higher. At that point, we just don't know. We have to update the information as it comes. So here was my thinking and my conversation with Dan as I looked at this. So I said to Dan, look, Dan, we like the way this looks as a potential bottom. However, bottoming patterns by definition can take time, and they wiggle back and forth. Sometimes they have little breakout failures. They come back in again until eventually the selling subsides, and at some point, if it's going to happen, the upside momentum begins to take hold and things start to move a bit faster. So the question I had was, Dan, if I buy this here and I don't mind holding on to it, which could be for a month or 2 months, whatever it may be, well, I'm just holding on to this position and letting it wiggle around and do whatever it's going to do as long as it doesn't hit my stop. Now, my question was, if we do options with this thing, and options, being that melting ice cube, as Dan has said in his classes, I was like, well, Dan, my money is melting eventually, so I don't mind holding on to this ETF. Well, my option strategy here might eventually, the position may work out, but meanwhile the options aren't worth much. So we had that conversation. I'm going to let Dan explain the thinking behind that. So take it away, Dan.
All right, thanks, Greg. And Greg, you didn't even do that purposely, but that was like a beautiful introduction to the benefits of why we trade options, which is we put on strategies. Obviously, everything we do starts with an analysis of the chart on multiple time frames. Then we determine what type of trade we want to overlay on top of that to meet our expectations. When we have multiple time frames in alignment, we want to institute a very bullish or bearish directional trade without capping our gains. So that's a deep in the money call, for example, if we're bullish, things of that sort. We don't want to cap our gains. When we have something that's mildly bullish, we still want to profit from the upside, but we're willing to cap our upside because we don't have a piggish target. And this is a perfect setup, as Greg's explaining, on a bottoming pattern. It's not ready to start its sprint around the racetrack. It could take a while. So we're going to look to deploy not only an income strategy of selling some out-of-the-money puts, but we're also going to do a mildly bullish strategy by recommending a bullish diagonal trade. So let me explain both of those. So back here, to pick the strike, our daily here, the low is right here around 66. You could go higher, but we're gonna just call on this particular trade a short-term bottom, and we're just gonna make a bet that it's not gonna close under 66 by June expiration. So I pull up my option table, XLE, this is Thinkorswim platform, calls on the left, puts on the right. We are, today is Saturday, so on Monday, this is going to be 25 days to expiration for June, third Friday of June. We are going to sell the $65 put. So I have it defaulted as a 10 lot. So we sell a 10 lot of those, and then we're going to buy out of the money puts just to limit the margin and to give us that catastrophic insurance just by having a spread. So we'll recommend buying the out of the money $60 puts. So here's my single order. This is a bull put spread, and based on these closing prices on a 10 lot, we would take in $520, risking the width of the spread less $520. So that would be $3,480. 520 divided by $3,480 is, I don't have a calculator, but that's like over 30% return. That's a great ROI for 25 days. So that's trade number one. Now let's talk about trade number two. In our bucket of mildly bullish trades, here's what we teach. A covered call. So Greg said, can I buy XLE? Sure you can. But I would then be looking to sell an out-of-the-money call to lower my cost basis and improve the probability of profit, because my cost basis is less than Greg's, who is just buying the stock outright, hypothetically. We could also do a bull call spread. Buy one call, sell an out-of-the-money call. When we want to stay in a trade longer than just a regular 1 month or less bull call spread, we recommend what we call a bull diagonal spread, which is identical to a bull call spread with one exception. The in the money deeper call, we're just going further out in time because I want to stay in the trade longer. But the intent is to constantly sell out of the money calls against this longer dated in the money call for the identical reason of a bull call spread and a covered call, namely, constantly bring in premium from the out-of-the-money calls to lower your cost basis. So here's what we're going to recommend on this trade. I really wanted to go out like 60 to 70 days, but look at my expirations available right now for XLE. So 41, I mean, that was a possibility, but as long as we aren't paying a lot of time value, then I don't mind going further out in time. So we're going to recommend these September in-the-money calls. So we're going to have 116 days on Monday of time value. So that's 4 months that we can be in this trade if we want to, with the intent, as long as it stays bullish or mildly bullish or sideways, we are going to make money on the out-of-the-money call time decay day by day. That's our theta time decay income. So which in-the-money call do I recommend? Well, I'm going to be looking at the delta. Our starting point is delta of 70 for our in-the-money directional strategies. What does delta of 70 mean? It means for every $1 increase in the underlying, which is XLE, this option should go up 70 cents a share. And that's a good trade-off between the reward that we're getting on the upside and the minimal amount of time decay. And then another way just to eyeball the time decay is I look on the corresponding put side and for the same strike price, and I can see how much time premium we're paying. So we're going to actually recommend, well, I did recommend this 70. So it's going to be the 64.5 in the money September call at midpoint. And it closed at 430 to 450, so midpoint would be 440. And we're paying roughly $1.65 in time value, but that's for 116 days of time, so that doesn't bother us at all. And the intent is going to be sell monthly out-of-the-money calls every single month or sooner. We could sell 2 or 3 week premium. So let's load up this one. We'd be buying 64.5, and then I want to sell an out-of-the-money call. So we're going to go to, let's go back to our chart here. Which call do we want to sell? I would prefer selling the $71 calls, which is right here, because I wouldn't mind capping my gain there, because that would be a beautiful, huge run if it did that within the next 25 days. But on the quotes, we aren't getting as much premium for the 71s. So we're just going to recommend the 69s. Let's see. No, I think I did recommend, yeah, the 70s. Okay, so then I hit the bid on that. It loads up the midpoint. Buying the in-the-money 64.5 Septembers and selling the front month June $70 out-of-the-money calls. The midpoint right now is $4.26 a share, and that's the trade we're going to recommend once it trades over intraday resistance, which I think is like a dime higher or something like that. I'll post it for you. So that is our bull call diagonal, mildly bullish trade, in addition to selling the out-of-the-money put spread, which in our opinion is a great, it's a great compromise to entering this trade as it's showing these bottoming characteristics. So that's all I have, Greg. Any concluding comments?
That's great analysis, Dan, and going over that and the just covering the diagonal and explaining that. I mean, it just makes great sense, you know, as you went through that, how to lower the cost, and you know that resistance area there would obviously be a stopping point. If it went through it, you know, you're profiting from that, and if it backs off from there, you know, that option going to expire in value, and you just sell another one as time goes on, and you've got, you know, the other one working for you from the longer term perspective. So it's a great strategy.
Exactly right. And if a chart turns mildly bullish to what I refer to as fully bullish, then we simply buy the out-of-the-money call option back. And based on how many days and where the stock is at that point in time, it would be at a, you know, small gain or loss at that time, but not a net loss, because if we did buy the short call back at a loss, by definition, that means that the stock advanced, and the gain on our long call would dwarf the small loss on the short call, if that makes sense.
Total. So, Dan, I mean, what you've explained right here in your options course that you've just completed, is this a pretty good example of the things that you've covered and explain, you know, how to use these strategies?
Absolutely, and I hope everybody followed what we talk about and this webinar, this little lesson right here. And yes, the 10-module option course is designed to teach beginners, intermediate, and even if you're advanced, you're going to be shocked to see how simple it is the way we lay it out, both in terms of chart recognition with picking the right strategy of bucket number 1, directional, bucket number 2, generating weekly and monthly income. And we've already had a few of our close colleagues watch it, and they just think it's outstanding.
All right, everybody, terrific. Guys, hope you've enjoyed this. I mean, this is some of the things that Dan and I go through on a daily basis, looking for trade selections, going through the technical parts and then reviewing the options tables, to select which strikes to use and strategies. So, this is what we do every day. Hope you've enjoyed the lesson and picked up a few pointers from it. And, we'll do some more of these in the future. So have a great trading day and week. And just as a side note, it should be interesting to continue with the drama going on in Washington as it unfolds. It's like a soap opera.
That's quite an understatement. Have a great trading week.
Bye-bye.